Welcome to the Mercer Ledger, July 15th, 2026. Oil prices remain elevated. West Texas Intermediate moved near $78 and Brent cleared $80. The main reason is fresh tension between the U.S. and Iran around the Strait of Hormuz. Markets are reacting to the immediate risk. That makes sense in the short term, but it does not tell the full story. Underneath the headlines, a supply buildup is forming. Saudi Arabia made one of its largest price cuts in decades to protect its market share. OPEC Plus is adding more production for August. U.S. shale output is holding steady, with some companies slowly increasing activity in response to higher prices. At the same time, Hormuz tanker traffic remains limited. Every day of restricted flow adds to the backlog of oil that cannot reach the market yet. This combination is the real dynamic. The current price rise is a short-term boost from geopolitical worries. It does not remove the supply pressure that has been building since early July. When the tension eases or a technical agreement moves forward, that pent-up oil can hit the market. The highest probability path begins with a sharp, violent flush as soon as the geopolitical premium fades and leveraged longs are forced to liquidate. However, because the underlying fundamentals are broken, this initial flush is likely to become a sustained long-term structural downturn that drags pricing below $55 a barrel. The delay in Hormuz is not solving the glut. It is letting the backlog grow. This can make the eventual drop sharper when the oil finally flows. The lag effects are still in motion. Higher freight costs from earlier periods continue to work their way through the system. Upstream pressure on margins has not gone away. Consumers will feel these effects on the 14 to 30-day horizon no matter what the headlines say next. What to watch? How long the Iran-related premium lasts. A quick fade would support the flush scenario. Gulf tanker traffic and storage levels, faster recovery would increase supply pressure. Speculative positioning in the market. Any new comments from Saudi Arabia or OPEC Plus on production plans. The surge in pricing is real. It is also masking the bigger picture. The supply mechanics have not changed. Treat the current prices as a temporary overlay rather than a lasting shift.